You've heard it a million times. Compounding is the eighth wonder of the world. But what if I told you that same compounding can quietly destroy your stock portfolio if you're not careful? In this video, I'll show you how compounding works against you with real examples from the stock market and how you can protect your wealth before it's too late. Let's get this straight. Compounding is powerful, but it's a double-edged sword. When your investments grow, compounding multiplies your returns, but when your investments fall, losses compound too, and much faster than you think. Let's say you lose 10% every year for 3 years. Year 1, 100,000 rupees to 90,000 rupees. Year 2, 90,000 rupees to 81,000 rupees. Year 3, 81,000 rupees to 70,900 rupees. That's not a 30% loss, it's 27.1%, but it feels worse because your money is shrinking on a shrinking base. That's negative compounding in action. Now let's talk about the silent killers. Fees. A 2% annual fee may seem small, but over 20 years, it can eat up lakhs of rupees. If your returns are 8%, a 2% fee brings it down to 6%, and thanks to compounding, that 2% gap over decades could cost you more than 30 to 40% of your wealth. Emotional investing, buying during market highs, panicking during crashes, chasing hot stocks, these mistakes compound too, but in the wrong direction. In volatile markets, reactive decisions is compounding mistakes. Let me give you a real story. Yes Bank. In 2018, it was trading at 400 rupees. By 2020, it collapsed to 40 rupees. A 90% fall. Imagine you put 1 lakh in 2018. By 2020, it's worth just 10,000. To recover, you now need a 900% return. Let that sink in. That's compounding destroying your capital. And investors made it worse by holding on with blind hope, averaging down, ignoring risk, failing to cut losses. So how do you stop compounding from working against you? Use stop losses. Never let small losses turn into disasters. Diversify. Don't put all your money in one stock, even if it's a market darling. Rebalance. Adjust your asset allocation regularly. Take profits from stocks that have grown too much and reallocate to safer assets. Avoid overtrading. Brokerage taxes and timing mistakes compound silently. Think long term, act rationally. Short term volatility is noise. Stick to your process. Don't chase, don't panic. Compounding isn't your enemy, misusing it is. If you control risk, avoid big drawdowns, minimize fees, stay emotionally disciplined, then compounding becomes your greatest ally. But if you ignore these, it becomes the reason your portfolio never recovers. Let me ask you this, have you ever held on to a stock that kept falling, hoping it would bounce back? Let me know in the comments. And if you found this video helpful, give it a like and don't forget to subscribe for more content on smart investing. Remember, in the stock market, it's not just about what you earn, it's about what you avoid losing. Thanks for watching Vibhava Wealth.